Hello and welcome to this webinar where we shall be discussing crude oil, Donald Trump, and most importantly, how to increase your chances of trading crude successfully. My name is Sasha and I'm a financial analyst here at 4Trade. Before we begin, it's important to understand a few basics. So, as well as show you how geopolitical crises like Iran can affect crude, I'll briefly tell you which economic releases to look out for, which can influence oil prices up or down. This webinar won't cover technical analysis, but if you use technical analysis, you can continue to do so. If you decide to trade on crude, you might find it beneficial to use fundamental analysis, which I will be providing here. Lastly, I will be showing you how to easily open a position to trade on our platform, the Web4Trader. You'll be surprised how easy it is. Right, let's get on. Before we begin, you should take a moment to read the risk warning and disclaimer. Alongside the potential rewards, trading in CFDs and leveraged products carries a level of risk, and as a responsible company, we want you to know this. Okay, at this point, I'd just like to ask you not to click away until the end of this presentation, as we've got a very special offer coming up. And this one truly is a one-off special offer that will significantly affect your trading experience. Do yourself a favor and consider taking advantage of it. We'll also show you what we call a market opportunity in a very practical way. So let's get started. When Donald Trump won the presidency of the United States, he promised to be a friend of the oil industry and stated he would increase US oil production. Environmental concerns will be pushed to one side, and US oil companies could be assured of support from the US government. This was part of his strategy to take the oil, suggesting that seizing Middle Eastern oil will cut off funding to ISIS. The practical impact, as we will look at in a moment, has been to put pressure on oil prices through increased US production and conversely to push crude prices by using US power through geopolitical means in the Middle East. The former US administration under President Obama, co-sponsored by a number of other countries such as Russia, China, Germany, and the UK, made a deal with Iran. The Iranians undertook to stop their nuclear weapons program, and in return, sanctions on Iran would be lifted, enabling the country to economically develop. It was thought that such a strategy would strengthen moderate forces in the country. Now, let's take a look at the price of crude and how it's been affected by developments in Iran. As you can see here, in December 2006, the United Nations Security Council imposed sanctions on the country. The markets reacted, and the price of crude pushed as high as $150 per barrel, before dropping in late 2008. In recent years, US production increased with the arrival of shale oil. This drove prices downward, as can be seen in green. The red line also shows when the US under Obama reached the deal with Iran in 2015, allowing Iranian oil production to flow at the beginning of 2016. Iran produced just over 3.8 million barrels of oil per day in April, according to the latest S&P Global Platts OPEC survey. On the graph here, we can see Iranian crude production since April 2017. But before then, just as the nuclear deal took effect in 2016, Iran only produced 2.9 million barrels a day. Clearly, the threat of a loss of this amount of oil per month affects the markets, as we saw on the previous slide. The role of OPEC is also important, since OPEC countries, of which Iran is a member, can either reduce or increase oil production of member countries, which can make crude prices less volatile. President Trump has long opposed the Iranian deal, calling it the worst deal ever negotiated, and stated on May the 8th that the US will no longer abide by it. What is of interest directly to us as traders is that the prospect and now the reality of the US reintroducing sanctions upon Iran has caused the price of crude to grow to its highest level of 71.8 since November 2014. That's some 3.5 years. Traditionally, geopolitical instability in the Middle East tends to influence an increase in crude prices. US reimposition of sanctions against Iran has caused hardening of positions. Late last week, we saw Iranian positions in Syria bomb Israel, and Israel responding in kind. The threat of conflict in the region and the potential disruption of oil supplies go hand in hand. Thus, traders tend to watch out for conflict or moves towards peace and factor this into their buying or selling positions when trading crude. Traders know it's important to understand the role of the Organization of Petroleum Exporting Countries, OPEC, which includes many of the largest oil producers in the world, including Saudi Arabia. The organization generates some 44% of all world oil production. It agrees jointly whether to increase the production of oil, which should influence prices down, or to restrict oil production, which should help push oil prices up. Since 2016, the organization has successfully invited Russia, the top producer of crude, to join these agreements, even if Russia isn't formally part of OPEC. OPEC and Russia currently have an agreement to restrict the supply of crude oil until the end of December 2018. So, since Russia is the world's number one producer, Russia and OPEC has considerable power to influence oil prices that directly impacts your trading. Iran is the third largest crude oil producer within OPEC. So the threat of sanctions naturally called into question whether supplies will be disrupted, pushing oil prices up. However, following the reimposition of sanctions, OPEC kingpin Saudi Arabia indicated it was ready to act to fill any gap in supplies. In a statement last week, the Saudi Energy Ministry said it was committed to supporting the stability of oil markets. It said the kingdom will work with major producers within and outside OPEC to reduce the impact of any potential supply shortages. But analysts say Saudi Arabia would like to keep prices rising ahead of the IPO of its state-owned oil giant, Saudi Aramco. As might be expected since this statement, crude prices have fallen after this statement, although remain above 70 and close to previous highs. Traders will now be looking closely to statements from leading OPEC and non-OPEC countries to see whether the current supply limitation deal will be suspended or similar measures undertaken to increase the flow of oil. That might potentially reduce the price of crude, but it's not in prospect yet. Alongside OPEC, there is soaring US production to consider. The US has now overtaken Saudi Arabia and is the second largest oil producer in the world, only behind Russia, which produces 11 million barrels per day. However, US oil production, powered by US shale producers, will total 12 million barrels per day by the fourth quarter of 2019, according to the Energy Information Administration's report from May. The point to bear in mind is that if US production continues to increase, at some point, markets may decide there is too much supply and oil prices may eventually fall. But for now, this doesn't seem to be a factor. As the largest oil producer, Russian production has the greatest influence on prices. Although since 2016, the country has agreed to limit production as part of the deal I was talking about with OPEC. Doubtless, Russia has found it useful and prestigious for geopolitical factors to team up with OPEC in order to set oil prices. However, it's thought that Russian oil producers would like to take advantage of higher oil prices and produce more. Apart from geopolitical factors such as Iran, potential conflict in the Middle East, or the economic crisis in oil producer Venezuela, there are a number of weekly reports that traders should be aware of. You have the weekly crude oil stock. On Tuesdays, you can see on the screen, it's at 9:30 GMT plus 1. On Wednesdays, you have the crude oil inventories at 6 o'clock GMT plus 1. And you have the Baker Hughes oil rig count at 6 o'clock GMT +1 on Fridays. Even if you don't have time to follow these reports regularly, you should be aware of them. The three most important weekly reports I've already spoken about. To not complicate matters, the only thing you need to know is that higher than expected numbers tend to influence crude prices lower. And Friday's Baker Hughes oil rig count released at 6 in the evening is the opposite. A higher number of oil rigs implies US production will rise, which tends to influence crude prices lower. OPEC's monthly market report is also worth consideration and includes forecasts. Since we have fresh data from this week, I've included some of their conclusions in the next part of this webinar. It's very brief. While it's not possible to predict the future, most analysts appear to agree that in the short term, oil prices could trade in the higher ranges, or at least maintain value. Analysts at Nomura, a respected financial services group, for example, state that continued tensions in the Middle East have the potential to keep oil prices elevated or push them higher. OPEC's monthly oil market report released on Monday this week also suggests that oil prices will maintain value at least. The report states that world demand for oil will be higher than previous predictions this year. It speaks of a decline in inventories, and it states that shale is facing logistical constraints. It also talks about Venezuelan output declining due to the economic and political crisis. These factors all suggest that oil prices could maintain value at the very least, if not increase. On the other hand, if OPEC decided to end its production limitation deal and crank up production of crude, if global economic growth was to slow and a diplomatic solution was found for the US and their concerns about the Iranian nuclear weapons program, which seems highly unlikely, oil prices could reverse. In the meantime, traders will be watching out for statements from Saudi Arabia and Russian officials for hints as to whether the organization will abandon its supply limitation agreement, which was due to be extended at the end of the year, as I said previously. In light of reduced production from Iran, we will have a far better idea of future direction next month. OPEC is due to meet on June the 22nd. What we can say for sure is that our weekly economic releases suggest that demand for oil remains high, and that the oil glut of previous years has gone. Finally, bear in mind that the threat of conflict in the Middle East tends to affect prices. It is worth following the news and factoring events into your trading decisions. Crude is an exciting instrument to trade on right now, but keep the information provided in this webinar in mind, and remember that crude is a volatile instrument to trade with. But to return to an important factor for you. To be completely clear, a market opportunity is a one-page briefing containing market analysis, and our goal is to provide clients with a simple-to-understand opportunity to trade on the markets. Market opportunities are provided by our research department on a daily basis, according to market conditions, and based on historical evidence. Our account managers will pass on these trading opportunities to you, but of course it's up to you, our clients, to decide whether you want to take up a market opportunity. Either way, we will provide you with the most important economic news and analysis, so you can make an informed decision about what to trade. A market opportunity consists of geopolitical events, fundamental analysis, and some technical analysis. So, to show you what a market opportunity looks like, please take a look at the screen. Here you can read some fundamental analysis on what's going on with the euro-dollar currency pair. Below you can see some geopolitical events that can influence the euro-dollar currency pair. It's important to look at the pivot point on which your calculations are based. Now, if the price reaches this level that you can see on the screen, which is encircled in blue on the left-hand side, where it says pivot point, if it reaches this level, this shows the right moment in our estimation for you to open a trading position if you're using a market opportunity. Again, this is just an example of a market opportunity, and it's entirely your decision whether you want to take advantage of it and trade using a market opportunity. And of course, your account manager will explain to you all about what a market opportunity is, if anything is unclear. It's also important to know how to use a stop loss and take profit options. You have support and resistance levels here at the bottom left-hand side of the screen. At these points, you can place a stop loss and take profit order, and on the top hand right of the screen, you have calculations. If you close the position using take profit, you can expect those types of profits at resistance 1, 2, and 3 in green. If the price is going against you, you can potentially have a loss of this amount, support 1, 2, and 3, and that's in red. All of the profit and loss calculations you can see on the top right of the screen are based on a one-lot trading volume. Okay, now for the good part. We have a very special offer for all of you here. If you make your first deposit within 48 hours of this presentation, we will assign you a 15% balance bonus on that amount. The balance bonus is real money from the company budget, and you can use that money to trade with. The money itself can't be withdrawn immediately before you trade a certain volume. Okay, so now I'm going to show you how to open a position on our platform. Here's one I prepared earlier, as they say. So if you go to the 4Trade website, which is 4trade.com, and you, let's see, you put your mouse over platforms, which is here, and then you click on Web 4Trader. It will take you to this screen. Once you click on Go to Web 4Trader, you will have this login page. So as you can see, I've already put my email address here. I'll just type in the password. I should say that if you have any problems accessing Web4Trader, just call your account manager and they'll give you a step-by-step guide. Right. So I've entered the details. Now we're logged in. We can actually see the 4Trader platform. Once I get rid of this message here. Okay, on the left-hand side, we can see a number of popular instruments that we can trade on. Today, of course, we are going to trade on crude oil, since it's a very interesting instrument right now, and it's the topic of this webinar. And I think we are going to click on buy. Because I think the price of crude is likely to go up in the near future. Now you can see the screen asking how much I want to trade. Since I'm using a free account, I have a choice between 10, 50, 100, 500, and so on. But as you can see here, with my available margin, I can trade up to 14,000. I think I'm just going to trade 10 units. I'll start small. And then I click on buy. As you can see, it says that the trade was opened successfully. Then that's how easy it is. Hopefully the price of crude will go up, which you can see over on this hand side of the screen. So you can watch. Hopefully you'll be watching it go up. If you were to open a buy position. If you were to open a sell position, you would be hoping that crude would go down. So that's it for this webinar. I hope you enjoyed the presentation, and please join us at 4Trade again soon.